have the most exciting panel to wake everyone up from their food coma. So as Dion said, this is the WAML. So buckle up. It's going to be great. A great panel, great topics. I've personally been talking at the last, well, now it's 3 digital accords. So I think our first one was 1.5 years, almost 2 years ago now, talking about CARF. And at that time, talking about CARF from understanding the regulation perspective, very engaging. From the operational perspective, it's kind of like, yeah, I got 2 years. It wasn't necessarily taken as seriously as I think it will be today. We're less than 2 months away from the actual first milestone of these regulations. And I think especially for many of the people, well, all of the people in this panel, after living through CRS, we definitely take it seriously and understand the massive amount of operational challenges and considerations, not only from an internal perspective, but from a regulatory perspective of digesting those regulations and the gray areas that still exist. So I think overall, while all of the advice we're going to give today, we still have a lot of open issues. I mean, look, we've already heard from nearly every panel, 2 jurisdictions alone, Canada and Switzerland, started delaying. We're still going to see a lot of changes. So hopefully we're going to walk away with concrete next steps and understanding, but I think we're still going to be talking about this for many more years to come. So with that, I'd love to have my panel introduce themselves. Jessalyn, would you like to go?
Sure. I'm Jessalyn Dean. That is me. I don't keep updating my photos. And I'm sure there's some surprises in the room of people that had not recognized me yet until this moment. So I am an independent advisor with Dune Consultants. It's just me. But my background, I actually, 13 years ago now, was implementing FATCA and CRS in a mutual fund house in the United States. So I've sort of been in this area since the birth of these regulations. Later, I was with PwC out of San Francisco, then Dublin, Ireland, then Amsterdam. So I've lived in Europe now for 8 years. And I've also been working on the DAC 7 OECD model rules for digital platforms. And today I primarily advise what I call crypto-native companies, startups, fintechs, the institutions that have not been around for 10 years, the institutions that did not implement FATCA and CRS for various reasons. Those are primarily my client base that I work on.
Yeah, I'm Corinna Hedtke. I work for Standard Chartered Bank, so I'm come from trade finance, so we're a global financial institution. However, so I'm the regional lead for Middle East, Africa, and Europe. And Pakistan, very important. And then in this context, I'm at the bank, I'm with group tax, but at the same time, I'm also I'm the lead in terms of digital assets Standard Chartered Bank is offering, because for them, it's really very much at the forefront. They want to be very much at the forefront, investing and making business proposition in the space of digital assets. And in addition, Standard Chartered Bank has got quite a lot of ventures, which are native crypto companies, firms, and we are also having, taking care of them as well. So and I'm therefore doing quite a lot of advisory and advocacy at OECD level.
Layla?
Yeah. Good afternoon, everyone. Layla Majed. I'm head of tax of Société Générale Security Services. So I cover, let's say, the traditional part of the custody, but also I cover also the tax aspect related to our subsidiary, SG Forge, which is the digital asset arm of our group. And within Société Générale, we try to bridge between the strat finance and, let's say, the blockchain innovative financial system. And I also participate with Corinna and Dion in the business advisory group, and we worked a lot on the tokenization. Yes. This is Corinna, this is you. You forget to mention it. Okay. She's also very active.
Awesome. Well, as I mentioned, and I think we've heard from a few other panels, we are officially heading into our first milestone with CARF, which is really around the due diligence requirements. And so, Jessalyn, I would just love to hear overall, your thoughts on this and what you've been speaking with clients to help them better understand what this means.
Yeah, so we use the term Wave 1 to refer to the earlier adopting jurisdictions that need to implement the CARF, potentially some CRS. So let's just take a step back to set in the room for different knowledge levels. CARF and CRS ask us to do primarily one thing: annually report the account balances and or transactions of financial events of various taxpayers so that governments can exchange that information cross-border. And we heard from earlier panels about what various governments would like to do with that information, but also how it helps taxpayers comply with their own tax obligations. In order to do annual reporting and know where a customer is tax resident, you need to perform due diligence on them. Some people like calling this like tax KYC. It's just a little more friendly lingo to say you need to know where your customers are tax resident in order to know which files they get put into which jurisdictions they ultimately get reported to. So due diligence has a huge quantity of complications to it, which we'll say largely go into effect in 2 months, January 1st, 2026, where an RCASP under the CARF will need to obtain a self-certification from new account holders to understand their name, their entity classification if they're an entity, their tax residency, tax ID number, possibly date and place of birth, and if they're an entity, potentially identity and roles of underlying controlling persons. So due diligence starts on January 1st, 2026. We did hear that 2 countries are postponing the CARF, but we actually don't have the details of what that means yet. Maybe those countries still require due diligence to start on new account holders from January 1st, but that they're deferring the reporting and international exchanges. The devil's in the detail. So it's not pencils down for those jurisdictions. And as we'll get into a little bit more, where an entity has multi-jurisdiction exposure, nexus in multiple places, they may still need to do due diligence in these other countries. A couple other notes of just a couple bullets of what actually does an institution need to do to prepare for that 1 January. The first is to identify who in their account records is a pre-existing account or not. That seems straightforward. Unfortunately, it's not. The draft Switzerland guidance, for example, stated that if an account was opened, you got the paperwork done to allow the user to enter your platform, it's not a pre-existing account until you've provided relevant crypto services to them. So there's a question there. If the user never transferred anything in, never bought anything, but the account was opened, is it pre-existing or not? So step 1 is actually identifying who's a pre-existing account and who is not. Why does that matter? Because new account holders need to be documented from 1 January, but pre-existing account holders, you have a larger time frame to document them. This is also relevant because if you have exposure to the Common Reporting Standard requirements, which we'll talk about more, you may be able to rely on your self-certifications that you got under the CRS. So that's good news, but again, it depends on the jurisdiction and the guidance, how that actually plays out. And my last point, and I hope this is not alarming to anyone in the room, but it was alarming to someone I said this to recently. If you've got tokenized equities, you don't just have a CRS and CARF documentation problem, you've got a FATCA documentation problem. And not only do you have a FATCA documentation problem, your FATCA and CRS documentation problems exist right now as I speak. It's not from January 1st. That's because a tokenized equity is still an equity, and equities are financial assets under the CRS and FATCA, which means they need to be documented right now. So if that's alarming to anyone, feel free to come talk to me afterwards. You don't need to make yourself known. Okay, so that's my overview.
Awesome. You made a million points that I would love to spend 2 hours on. I don't know if we have it. I think the biggest thing I would like to echo what Jessalyn just said, these new due diligence requirements are not the existing KYC. rules. Especially within the crypto native companies that I've been working with, a bit of a misunderstanding. Oh, I already do a KYC. I'm good to go. We feel very prepared. So deeply understanding the due diligence requirements under CARF is incredibly important. There's many other thoughts I have on the tokenized equities as well, about 1441 and other things as well. But we'll move on. Corinna and Layla, you have lived through CRS. So you already have existing systems. To Jessalyn's point, I don't necessarily know if the user base crosses over between the digital asset products and the traditional financial products, but I'm just curious, do you feel ready to move forward today, or does the fact that you're already subject to CRS make this even more challenging? So, Corinna, I'll hand it over to you.
Generally speaking, I would say we as a financial institution, I would say we do have a head start. We shouldn't complain too much about that. I think native crypto companies, because as you rightly said, they may have never introduced such kind of due diligence procedures before because they were not affected by the existing CRS. So therefore, of course, we do have processes and procedures in place for the existing CRS. We have been collecting self-certification from our customers. We know exactly our client base. So therefore, of course, we can leverage off the existing due diligence and under CARF, of course, which is a benefit. But there's a huge but, only to a certain extent. And of course, it always then depends on your customer base. For individuals, if you've got retail clients, it will be relatively straightforward. But if it comes to entities, the kind of complexity with even this new definition of having an RCAS as a kind of entity client you may have, and what this then may imply in terms of, when you then effectuate any transactions with these clients and from now to then going forward, so you really need to be very much aware of, what is also pre-existing, what status does the entity have? Is it really then a reportable entity? Because currently RCAS were active NFEs, which is reportable under CRS, which will look different than going forward. And so also then to identify, are they going to be acting as intermediaries? Acting as an RCAS, effectuating transactions. So I think there is so much complexity. It's not so easy just to say, we are ready, because we are internally really grappling with the kind of nitty-gritty stuff. We do know, we will ask for a self-certification, but how do we implement the more complex rules, because it's on a transaction basis, under CARF, to see whether we have got all the relevant, really, key data points in place, which are different to the existing CRS. So there we have to, in the same way as any native crypto company firm, we have to look into this. What are our critical data points? What data points do we hold? Because for us, they will be clients. There will be the same client database. And depending on, we are not offering digital assets to the whole client base we have. So it will be certain segments, certain markets. So we're able to tailor it. And we will take a targeted approach. But still, it really means we have to look into very much the detail. What are we doing here? And it's really, for a bank, financial institution working in 56 jurisdictions, to see exactly what market, what business segment, to identify those and how then everything pans out.
Layla, I'm curious to hear your thoughts as well.
Yeah, if I may add to what Corinna said, we are also a traditional financial institution, and of course our starting point was actually to check with the CRS self-certification. But what we have realized quickly, that we are not talking about the same trigger. When it comes to CRS, it's about account opening, but when it comes to the CARF, the trigger is different. And our understanding is when you enter into a relationship with the user, and this is really a huge operational impact on us. So for us, it became quickly that the CARF is not just an add-on, it's a very different logic from CRS 2.0. And in that way, we have really to react differently to the CARF. So this is one of our, I think, operational difference. And the topic that we spent a lot of time asking ourselves when it comes to the trigger, I mean, we're like asking ourselves, should we ask the first question, are we a COSP? Are we a RCOSP? Should I identify first if I have a reportable transaction or if I have a reportable crypto asset? What about my reportable user? What about all of these? So which is the first trigger? And if I may add also, when you are under DAC 8, you have another layer of complexity, may I say that? Because when DAC 8 reference MiCA, so you have to ask, for example, if I have a regulated COSP, is it a trigger? Or should this COSP become reportable COSP to become a trigger? Because, you know, a COSP, I mean, it doesn't mean that we'll have exchange transaction under the CARF. And also, as you know, under DAC 8, the definition of services is much larger than what a regulator COSP can do. So, to your question, Erin, ready, I don't think I think there's a lot to do, and 2026 is tomorrow, so.
Well, Corinna and Layla, you bring up a follow-up question that I had, and the fact that, you know, Standard Charter is in 56 jurisdictions, you just said, and you just mentioned DAC 8 and the slight differences, right? What do we used to say? There's nothing common about the Common Reporting Standard, which I still say all the time, even though it's cheesy. But to that point, you're noting differences with DAC 8 versus, you know, other jurisdictions outside the EU. And then we layer on the fact that not all jurisdictions have issued or finalized their local guidance. How are you looking at this from a jurisdictional standpoint? I mean, can you even implement different processes across different jurisdictions with the systems that you have? I'm curious.
Yeah, if I will start. Yeah, I mean, in France, it's, I think, one of the countries that Hugo referenced it. We have enacted the DAC 8, but what we have noticed that, I mean, there's no, for example, technical guidelines. So even if there's a local, I mean, implementation, yet we see that there's no, I think, enough maturity to deal with that. And also when we tackle with different, I mean, jurisdiction, I think there's a lack of consistent definition, because even, I mean, if we have directive, we know that once the directive is implemented, we will have this local, you know, specificity. And so we have to navigate between this lack of consistency, not only between jurisdiction, but also, as been noted by my fellow panelists, between FATCA, between CRS, between the CARF. And this is why I think it's very difficult to have, local implementation, I mean, uneven local implementation.
Corinna, I'm curious how you're tackling those challenges.
Yeah, we are just, well, I think when you are such a global bank, then what you tend to do is always try to take the kind of highest umbrella, and of course that's the CARF itself. So that was for us the first way of tackling it and looking at it and saying, okay, we will look into this at a very much slightly later stage when it comes to local implementation. We know, okay, we are UK headquartered, we offer it here in the UK. So trading, so therefore it means, okay, we are called by the rules. We just heard we have got regulations in the UK. We've also now issued it's not draft guidance, we've issued guidance. So of course we know from our very recent conversations we had with HMRC, which is really good that it's so collaborative, that there are still so many open issues, and they've also already acknowledged even this guidance which has just been issued will change, whatever, probably until up to January, so we've got November, not much time left. So from that point of view, it's really like continuously monitoring what's happening. We are starting, what we do is always, we have got a kind of procedural internal document, which is then really having a so-called country annex for each jurisdiction, where we really, for each jurisdiction, monitor all the variances, which is really, well, it's really quite an intensive and kind of work we do on that, really to capture all the nuances, and which then need to be reflected. But on the other side, what we also see, because of our footprint, for example, we are called by the Nexus rules. And if you then say, okay, we are in the UAE, we offer it in the UAE. So if you then look into the kind of free zones, what we heard this morning, for example, and then you've got the branches itself in the UAE regulated by the central bank, and then you know, okay, well, these are branches of our UK entity, so they are caught under the nexus rules. How do we implement this if we then in a free zone have something, an entity which is part of the UK entity, and then in the UAE itself under the central bank, another entity which is from a regulatory point of view, one entity, but because of the setup in the UAE, it is separated. So how do you manage this then? How do you apply then the definition? Because we know at a later stage in the UAE, we always have in the free zones separate legislation to the one generally issued. So then this complexity, how do you apply this then going forward next year, applying the nexus rules? We have to say, we are still like having more or less daily conversations to discuss this within our teams to see, okay, where do we stand? What approach do we take in order to be safe? But on the other side, not heading into a particular direction where we know, okay, that was not the right one. So it's really quite intense at the moment.
Yeah. All of this just begs the question. Obviously, you have really done extensive analysis with at least what exists from a rule standpoint. I'm curious, Jessalyn, do you find the same level of depth of analysis happening with the crypto native companies that you work with in terms of the impact analysis? Things like Corinna just brought up, Nexus. There's the high level, am I an RCAS? But then when you start peeling the layers of the onion back, there's so many intricacies. So I'm just curious your thoughts on that and where they are.
Yeah, so the crypto natives, I'm calling them, that have not implemented FATCA or CRS in the past, there's kind of two tranches of these. Mm-hmm. There's the concerning bucket that don't have one of these experts in-house, and they haven't hired me yet or a Big Four. They don't know what they don't know, and they've got a product manager running ship on this. And this person just thinks, oh, I'll just outsource that to the software company. They call up a Taxbit or something and say, you'll take care of CARF for me, right?
We will.
And while a Taxbit or other software company provides software, they don't provide tax advice. And before you can map software to your transactions, you need to know what transactions are in scope. So I think that the first bucket of concerning ones are the ones that don't know what they don't know, and they're not undertaking product analyses and entity analyses that we've just described, which is absolutely necessary. And I think that they're going to end up at the very last minute coming to the software companies 2 months before the filing deadline to say, right, I'm ready to buy some software. And the software companies are going to say, well, where's your product analysis and your mapping of what's a SEMP and what's not a SEMP? And it's going to be a difficult conversation. The other category is the crypto natives that either have a person like us in-house or had brought in sort of people from TradFi that had a sense of this. They've gotten an advisor involved, and they are undertaking product analyses right now as we're speaking. I'm involved in a few of those to look at exactly this. Where do I have nexus? So a lot of my clients they're global, multinational crypto natives. They do business in many countries. And so they have to look at, and that's why I have to be able to navigate the requirements in multiple jurisdictions. I'm not just a UK CARF person or a Swiss CARF person. I also work on US 1099 reporting because my clients need to know how this all interacts everywhere in the world. So those analyses are being undertaken by those clients right now. And maybe I'll throw in another implementation two implementation challenges that I'm concerned about, or my clients are concerned about. The first one is to leverage what you mentioned. And again, if these people don't have experience with having done this 10 years ago, they may not be aware of this. They want to take they'll say, let's take the most strict set of rules and try to implement this across the board, especially when tax operations tends to come from like a centralized center of excellence. There's a person in New York responsible for all of this around the world. The problem is that GDPR and local privacy rules do not allow you to collect and report information unless you have a legal basis to do so. So you do need to do a multi-jurisdiction assessment of when can I collect information, when can I report information, so you're not over-reporting or potentially under-reporting. And the other concern, and I know some of the tax authority representatives in the room have heard me come talk to them about this, is the lack of implementation guidance about what you do when you don't have a self-certification from somebody. And Max and I were talking about this earlier as well. And I'm glad that Dion brought up the proportionality issue earlier. I think he really set the stage for the point I want to make, which is under the CRS, you may have had a jurisdiction that said if you can't get a self-certification from a pre-existing account or a day two new account, you may be required to close the account. So there is a way for the person to get their money back out. But what we've seen is some of the descriptions of what to do when you don't have a self-certification say, don't transact on the account. Well, there may not be a legal basis for you to hold that person's crypto hostage. So this is a big concern from some of my clients who are saying, if I can't get the self-cert, I'm going to face lawsuits from my customers if there was no legal basis for me to hold that crypto hostage from them. So this is a big concern from the implementation, again, multi-jurisdiction. What am I supposed to do when I can't get the certification?
Awesome. And you said two very controversial words, SEMP and Nexus, I feel like are the biggest topics we talk about. I'd love to just dive more into the SEMP. I think it's a very relevant because it then goes to the fact that everyone has made, we're not just talking about CARF at the end of the day, we're talking about more likely than not, CARF, CRS, and FATCA. So I'd just love to hear, Jessalyn, first from you, just an explanation for SEMP for those of you that haven't, dove into this, and then Corinna and Layla, how you're tackling that as well.
Yeah, so I'll give us a little definition of the SEMP. Everyone in the room is on the same page. I'll sort of touch on some of the concerns with the definition that earlier panels mentioned are being considered and worked out with Working Party 10 and the OECD. Mm-hmm. Before I run through the 5 bullets of what a SEMP is very shortly, it's important to know that the SEMP definition was not originated from crypto. The SEMP definition actually originated from e-money accounts, prepaid debit cards, Wise. I use Wise when I travel so I can spend some currency in another country. But because the actual funds are held at an actual bank, those were not considered deposit accounts under the original CRS. So CRS 2.0 was written to originally capture these like prepaid e-money accounts. So this is an important fact to understand the context of the SEMP definition. And then when the CARF was written, stable coins that also meet the definition of a SEMP would then end up in the same category as a prepaid debit card and e-money account. So the 5 things that are in a SEMP definition are that it's a digital representation of a single fiat currency. Mm-hmm. It's issued on receipt of funds for making payment transactions. These are largely not controversial yet. Represents a claim to the issuer denominated in the same fiat currency. Not many problems with that. The last 2 is where we have some problems. Accepted as payment by a natural person other than the issuer, and redeemable at any time and at par value for the same fiat currency in accordance with the regulatory requirements that apply to the RCASP, the provider. So I'll touch on the 2 kind of problems with it, and then I'll hand to the ladies here to hear how they're handling this. Overall, the problem here is that providers in this space need to figure out if something is a SEMP or not, because if it's a SEMP, it's reported under CRS. If it's not a SEMP, it's a CARF event. It changes how you do due diligence, who's a pre-existing account, how long you have to document them, what it is that you report. It's a huge difference. Okay, the 2 problems. Crypto natives, again, the companies that didn't ever implement FATCA and CRS, your Coinbases, your Krakens, your Bit Pandas of the world, they normally let you transfer in fiat some euro into an account, and that's held at an underlying bank, and then you can use that euro to go buy some Bitcoin or ETH or whatever. You can also just hold the funds there. There's usually not a limit on keeping it there. The problem is there are tax advisors out there that are postulating that these are not SEMPs and they are not deposit accounts and they won't be reported under CRS or FATCA or CARF at all. And the argument is that they're not like e-money, they're not like a WISE account where you go spend it to travel, because it's not accepted as payment by a natural person other than the issuer. Jessalyn can't spend her euro out of her Coinbase fiat euro account. It's just for buying the crypto and then maybe withdrawing back in a separate transaction to her, ABN AMRO account. So, so that's a first problem, is that we might end up with different interpretations that is not reportable anywhere at all. And it's not crypto, it's not a digital asset. It's fiat and it's held at a different bank. And then the other problem is with the fifth bullet, the question to OECD and Working Party 10, tell me who's a SEMP. Can you give us a list of who's a SEMP? And the problem is, if you've got your MiCA license, let's say you're licensed in Malta, you've got customers in EU member states, but you've also got customers in Switzerland and the UK and other countries. You're not subject to MiCA in those jurisdictions, which means while you might have a requirement to redeem one-for-one in your EU member state for your EU member state customers, you may not for your customers in another country. And now the SEMP classification is based at the customer level rather than at the entity level, and that's a really bad outcome. So I'll hand it to the ladies to explain why that's a bad outcome and how they're dealing with it.
Yeah, do you want me to? Okay. So yes, at our level, I mean, at the global institution, when it comes to SEMP, I mean, we play a different role. So we have like the issuer role, and we have also, let's say, the custodian role. And with some of our distributor, we have also, let's say, distributor role and user role. So indeed, yeah, I mean, the SEMP issue is really a hot topic, yes, even for a traditional financial institution that entering this digital asset space. And again, I mean, for me, when it comes to DAC 8, it's also adds some layer of complexity. Because as you said, actually, Jessalyn, I want to focus on one point. As you said, when it comes to SEMP, it's already regulated by, I mean, for a European level, there's a European directive. So the question, also the first question that we asked to ourselves, is it also under CRS 1.0 before being 2.0? Because it's e-money. And when you delve into it, you ask, okay, but there's no account. I mean, when I talk to my, operationals, they, no, it makes no sense. I mean, no, EMT won't go under CS 1.0. It should be under 2.0. But I tell them, no, I mean, we have already the e-money considered as a financial account. So it's, and also from a regulatory perspective, for example, the financial regulatory, we call it the ACPR, that regulate e-money institution. I mean, for them, when you have, issue EMT, you don't have to have an account. So all these also add a layer of complexity about this new category that once you are an issuer in the European country, it should be considered as EMT. And I mean, interesting, and what is interest in this, that you may expect that this EMT will come under CARF, but no, it will come under CS 2.0, even it's a new category. So from our point of view, this is, complexity raises many questions on our due diligence. So, should we rely on, for example, the issuer qualification? Or should we perform more due diligence to, verify what's a SEMP is a SEMP, or is in the EMT, where is the stable coin, so how we treat this. So it's very, complex issue from our side.
Corinna, do you have any thoughts?
Yeah, I can only echo this. So it's really a rather complex issue, and I think it's in general, well, it's saying with regards to stablecoins, we heard early this morning when we were talking, the first talk about when Circle was here and how stablecoins are taking off. And I think it's these problems we're having is really reflected elsewhere as well. So it's not only just in relation to this very particular CARF regulation versus CRS to zero, and because stablecoins are just so quickly developing. So, and depending on how they actually develop, yeah, we've seen just like, for example, outside the EU, we know, okay, we've got MiCA here in the EU, and it's very, very easy and kind of straightforward because there is already one decision made how this should be defined in the first instance. But outside the EU, where you don't have MiCA, for example, then, of course, how is this approached? So we are having kind of engagement with the Hong Kong Monetary Authority and doing some kind of stablecoin issues, and the kind of request with the authority or the collaboration with the authorities is really how do you define this product from the outset before you issue it for the first time, and then see, okay, how should it be classified, and if you then, or when you make then your submission to the authorities, how do you place this? And of course, the business has got a very particular position on that, and arguing in a very certain way, because that's how it should be seen, because the stablecoin market is more or less developing in kind of somehow equivalent. I'm not saying cash because it's not cash.
Similar use case.
Yeah. So, but you can really use it. It's very similar to kind of having a kind of currency, and therefore it should be classified that way. So in order to facilitate then, or use it, or to facilitate certain business, yeah, because we also see how stablecoins in general are developing, being used for correspondent banking in certain regions, like Africa, for example. So therefore, it really depends on then how you define such a product. And I think in general with the CARF, what we see is really the classification of these kind of digital products is so much more difficult and complex than it was under CRS. So I would say there's such a different layer. So where we have got internal product codes, where we see we've got a similar product, where maybe very similar product codes, but then it's in a digitized way. And what we see, there are so many subcodes. And for each subcode of product, we have to then make a distinction and decision, where does it sit? Yeah. So which is so different what it was under CRS.
So you're bringing up that there's a multitude of differences with CRS compared to CARF, and the complexity under CARF. One of what we're talking about many, which we haven't really touched on yet, is the actual transactional and the nature of the information that you report forward once you've identified the customers that are in scope, right, and the products. But under the CRS, as we've talked on other panels about it, and we've talked on our panel, it was an account balance. I think of that as pretty vanilla compared to the complex ultimate analysis where you're looking at the type of transactions that fall in and out of scope, and then you're looking at the type of assets, which some could be driven, the asset alone could drive it into a different category of reporting. I'm curious what your thoughts are, because I did see, especially in the beginning days of CRS, a lot of movement towards more of an internal build. Obviously, you'd use a vendor for the actual XML generation, but you could determine ultimately what you should be reporting and get it on a template to generate the XML. I think it's going to be very different because there's an analysis that needs to happen across so many different aspects. How are you thinking about that aspect, the transactional aspect?
Right now, what I'm seeing in the market is there are conversations with software providers about, we know we need some software. We're not entirely sure what parts it's going to do yet. I think that's not a today problem for most of these providers. So it's very TBD. But I agree that the analysis is different. For example, and Max and I were talking about this earlier, you look at all your transactions, you aggregate purchases, you aggregate disposals, you aggregate transfers in, you aggregate transfers out. There's some more nuance in each of those subcategories though. And for example, the transfers, you might have transfers out to external wallet addresses, transfers out to wallets that are known to be associated with an FI or a VASP, not a CASP, a VASP. So now you're consulting a different set of regulations, and that might be a different software need to know what a wallet address that's associated with under a different rule set, and then making sure you aggregate transactions into that bucket properly. So I think the software needs are going to be very different, like you said. It's too early to tell if people are going to build or buy. It's not a today problem. Due diligence is the today problem.
100%. Corinna, I'm curious how you...
Yeah, I would say, so due diligence is one of the most pressing things, of course, because it starts 26. However, we have to say that we already kind of started the process of saying, okay, what's it's going to look at the very end. So having first sights, okay, what's out there? How comprehensive is the offering? What can we do on our own? What data do we have available? And then, of course, yes, constant discussion of what are these data points we need and how do you connect them? Do we have all the information? But particularly this, what you just said, okay, you have to really consider, is this a transfer to whom, and that you have to identify it, and then depending on that, you have to make a decision. And if you want to operationalize this, yeah, because it's not us who make the decision then, so it's really ops teams who have never heard about this regulation, or they don't know the difference simply, and you have to create something, a process software, which is then of course incorporates such a process. That there is someone making the decision. How do you capture this, and how do you really get it right? Because if you get it wrong, then you get everything wrong, more or less. So it's super. That's where really the challenge still lies.
So I also, agree with Corinna that due diligence is a priority, but we also started to actually, consider the reporting. And to start with this, I like to echo, Lawrence Zlatkin testimony when he, in the U.S. Senate, I think, Jessalyn, you shared this with us on LinkedIn. And he said we're trying to fit a 21st century innovation system into a 20 compliance system. Yeah. So this reflects how. So when we look at our, legacy system, we say, oh, okay, how can I support an aggregate reporting basis? It means I have to merge all the wallet of the client for one client. And also there's the diverse sources. There's a custody, but there's also the issuer, there are, the platform. So how I'm gonna aggregate all this diverse source and make it auditable, trail, and auditable, the flow of transaction. So it's very, very challenging. And one interesting idea also, and this, just to get back, this is US testimony, they were actually suggesting also to leverage on the technology to solve this problem. And they have actually, I find this very interesting, a tax attestation token that it will actually, it's a concept of providing a digital proof of compliance without transferring massive amount of data. So I found this interesting to check this. Use also the technology to solve the crypto asset reporting. Yeah, another token.
I'm sure, like you said, right now the focus is on this first milestone, but I'm sure there's going to be a lot more conversations, especially as we head towards the first reporting milestone. I had about 10 other questions, which we've run out of time for. It tells you how many topics are still open. I personally love this, but I did want to thank you to my amazing panel.
Thank you.